Well, tonight we're exploring some of the challenges that face beneficiary funds in South Africa. Given South Africa's wide social and demographic profile, we welcome our guest. Giselle, thank you so much for joining us today. So let's just take a step back. Give us the background to how beneficiary funds were kind of changed when it comes to where they fell in legislation, you know, under the Pension Funds Act. And I suppose it was all brought about as a result of the Fidentia scandal. J. Arthur Brown is yet to be sentenced on that. It's not about him tonight, but it is about the change in legislation and how beneficiary funds were born.
Thanks, Samantha. Beneficiary funds started, as you've said, when the Fidentia debacle started. Well, it was initiated by that. And in 2007, Trevor Manuel actually made an announcement during his budget speech that, you know, children's assets need to be protected better and better looked after. And that is when the discussion started in terms of beneficiary funds, creating the legislation for that, and also creating it under the Pension Funds Act, where the monies initially stem from retirements, you know, to make sure there's proper governance and protection for these children in beneficiary funds.
So of course we did, you know, do that introduction there, but very simplistically, before we get into the ins and outs of how they're structured and how trustees manage the money and their responsibilities, what is the beneficiary fund in very simple terms?
Beneficiary funds is basically a fund for minors. I normally refer to it as a retirement fund for children. And basically it is where the breadwinners passed on and their assets based on the trustees' allocation for these minor dependents, then that needs to be invested for them and looked after. And it's especially done in the situation where, for instance, it is determined that the capability of a guardian to manage the capital is insufficient, and therefore to protect the interests of the child, that it's important that it then be established in a beneficiary fund from where the child can then be granted a regular income on a monthly basis to look after the child, taking care of educational expenses, and obviously depending on the size of the capital will determine how far it goes, but then it has the proper regulatory protection in place to make sure that trustees manage it properly with its own board of trustees and make sure the children benefit properly from that.
Giselle, maybe just, I mean, let's take a step back here. Let's leave beneficiary funds, you know, kind of in its current form at the moment, and let's kind of take a step back into umbrella trusts. Now, this is just before Regulation 28 started kind of incorporating beneficiary funds and looking at minors and the better protection of minors. What legislation underpinned umbrella trusts at that stage? How did one look at legislation in that space, and especially the protection of minor assets?
Yeah, if I may say, Cobie, on that, in that regard, the Trust Property Control Act was the regulatory legislation that obviously governed the assets that was placed in a trust. And unfortunately, if you've looked through the Trust Property Control Act, it is all of 4 pages, with no indication in terms of other than saying that the trustees need to be prudent in the way it does investments, but no detail in terms of what the limitations should be to make sure the investments are sound.
Yeah, and I mean, that a lot has happened since then. So I mean, you've had Regulation 28 that's kind of taken over. You've had PF 130, which is a subset to Regulation 28, kind of coming in and asking trustees specifically to kind of think about governance and some of those kind of, and the structures that they need to be thinking about. Maybe just to quickly give you an indication about how these beneficiary funds look. Just look at the graphic on your screen at the moment, and there you can see retirement fund members, and you could see that on the death of a member, basically what happens is your beneficiary fund comes into play, and in essence, at the guardian's consent, the money will then flow into a trust fund, and that specifically is for the use of minors at the end of the day. Giselle, maybe just maybe let's just understand this a little bit better. When does a beneficiary fund come into play? Is it at the behest of a pension fund trustee and at a board of trustees? Is that in essence how this thing works?
That is essentially when, in the event of a death of a member, that the Board of Trustees has the discretion to decide on the distribution and the mode of distribution of these assets. And obviously beneficiary funds come in along with the mode of distribution. And as I've mentioned earlier, the capabilities of the guardian gets considered in the process and the interests of the child in that space. And if you looked at the slide we've just put up, there are 2 arrows showing approved benefits and unapproved benefits. And obviously, based on the current legislation, where, for instance, you'd have a testamentary trust, that would still be allowed. But most of the time, most of the assets would go into a beneficiary fund.
Let's talk about the power that a trustee has, because trustees are given considerable power, especially given the fact that they have the right to determine whether a guardian has, you know, the financial stability and ability to be able to manage the money that the child has inherited. So tell us about the powers that are given to the trustee.
The powers that trustees have is extremely wide. And if you ask anybody in our industry, that is about the biggest responsibility they have in the event of death claims, where they actually have to make these decisions that affect children for the rest of their lives. And based on that, there have been tools developed in the industry, which we call Guardian's financial assessment tools, which then basically assist the trustees to make that decision. So should the guardian come back in a few years' time and claim that, you know, I've had the ability to administer my child's assets, but you chose to put it in a beneficiary fund and I'm not happy with the administration or the investments or the performance thereof, they should have record of the fact that they actually assessed the competence before they made the decision.
This is a very contentious issue, though. And I'm sure, you know, if a guardian is deemed not eligible or not able to be able to manage the money, I'm sure it can turn into quite a, you know, fight between the trustee and the guardian.
Well, surprisingly, often they would agree to it because they would understand that they don't have the ability, the competence, and the investment world is a complex one. And also sometimes, strangely, you know, due to social pressure that the guardian would be under if she had received this big lump sum amount, for whatever reasons, she'd actually prefer to have it in a beneficiary fund so they
don't touch it.
Exactly, so nobody can ask her to actually help them with this, that and the other thing.
Guardians often are family members, right? And trustees aren't necessarily always a family member, so you have that kind of the personal issues creeping into these kind of decisions. But in terms of most people have life insurance, so the parents have life insurance. If on the death of a parent the life insurance pays out, is that something that also will be included in the distribution into a beneficiary fund?
Well, that is what we would...
What happens to that money that an insurance company pays out to the family or to the beneficiary, as it were, in the will?
Yeah. As it is defined in the Pension Funds Act, only assets that stem from retirement benefits may then go into the beneficiary fund, which means often there's group life associated with the retirement fund, and that would be the insurance of the deceased member in the fund. And that would then be included with the fund credit into the beneficiary fund for the minor dependent.
Now, I mean, if this is what happens here in South Africa, Giselle, I mean, and we're talking about specifically beneficiary funds here in South Africa, does this kind of thing happen globally as well? What kind of mechanisms are there specifically globally that potentially happens there? And maybe we can even learn from some of these.
I think surprisingly, this is quite uniquely South African. And I think South Africa, you will know, from a retirement fund point of view, is quite an advance in that area. And we haven't heard of any other country that does this. Most of the SADC countries would copy the legislation that we have and roll it out. We currently service members in Namibia, specific funds in Namibia, but there, for instance, lots of migrant workers whose family are in Swaziland, Lesotho, further north, Malawi, even further to the UK and USA, you know, for which beneficiaries still have their assets here that we're managing for them. But it's definitely expanding, especially in Southern Africa, and we hope it will go much further because it is really a very effective social tool.
I think also it's important to point out how important the appointment of a trustee is initially, because they have a lot of responsibility in the event that one of the breadwinners passes away or the breadwinner passes away, and they have to determine, you know, who the minors are. There's also issues around rural families in South Africa and city families, and you've got, you know, issues specifically to South Africa. So tell us about some of those challenges that do tend to come up in a country like ourselves.
Yeah. It's actually a very big responsibility for the retirement fund trustees, because often people do not have sufficient information on their nomination form, so you don't actually have a full set of records of who the dependents of the deceased is. It's a big task to find them. It's a big task to make sure people understand they actually need to come forward to be able to claim their monies and to state that they're dependent. And often it's a situation where people don't know that these things exist. They don't know that there are benefits to be claimed. People have cultural aspects where, for instance, the widow would go into a mourning period where she's not allowed to leave home. And therefore, by the time she gets to the fund, you know, the claim may have expired.
What is that period that you have to claim?
The trustees normally have 12 months to find the dependents and make decisions. But normally the mourning period is also 12 months. So, and often it's very complicated, and the death needs to be reported. You need to claim the insurance cover, the group life cover from the insurer within that period of time. So there's a lot of educational issues that is ongoing and that needs to be done constantly to make sure people understand how it works and the rights that they have.
Yeah, which, by the way, I mean, is exactly the issues that I think pension funds are dealing with here in South Africa. You know, here we're talking about beneficiaries now, or we're talking about the actual member that is now alive. He's no longer got, you know, the beneficiary hasn't come into play. But we're talking about education. We're talking about making specific investment choices within a defined contribution environment that specifically can help the member retire successfully down the line. Now, if you take the average factory worker, you know, trying to explain how the share market works, trying to explain how the bond market works, you know, inverse price correlations, I mean, it becomes very, very, very difficult. So I can only imagine once it kind of falls within the beneficiary space, you know, it must make it even more difficult, specifically because you're not taking traveling time into consideration and various other things, you know, and as you quite say, all the social nuances and everything else that needs to happen. Just to show you maybe quickly what some of the benefits are of beneficiary funds. So you can see them on your screen. And as a matter of fact, education actually is a fairly large one. I mean, your average size of a beneficiary fund is about 100,000 Rand. Now, I mean, if I take 100,000 Rand into consideration, I invest that for 18 years, even in a very low risk type portfolio, you're probably going to, you know, you're going to end up with a substantial amount of money. That's a fairly decent education. Are you finding that a lot of beneficiaries are getting a decent education out of this?
I think, Cobie, from the number of letters we've received from beneficiaries, it is very evident that, you know, the appreciation they actually indicate that the fact that if these monies were not invested for them and paid on a regular basis to fund education, that they're not sure they would ever have had an education with their breadwinner no longer being there. And it's been a big, you know, sometimes we even call it the educational funds of the retirement fund industry, because that's predominantly what it's become, to make sure that children has a monthly stipend, but also that they have funds to fund their education.
Yeah, and I mean, it's about alleviation of poverty at the end of the day. Otherwise, yes, the poverty gap literally just continues to increase.
So that's why they have, you know, specific social context in South Africa, and as you say, quite unique to South Africa.
Yes.
Talk to us about the issues around tax, in terms of the tax exemption that applies to beneficiary funds, or the money that is, you know, the returns that you get from the funds. So what are the issues around that?
I think the fact that beneficiary funds are also defined as retirement funds helps a lot in the sense that the same tax regime applies to beneficiary funds, which means there are no tax payable while the assets are in the fund, and neither no tax payable when the fund is closed for a specific child. So whatever the termination benefit is, the child will not be paying any tax. The only tax that is currently implied is the tax that accrues to the deceased member when the death takes place. Therefore, any death benefit above 315,000 more or less will attract tax of a minimum of 18%, and then it actually goes up with a sliding scale.
So it basically cuts into the funds that would go into the beneficiary fund.
Exactly. And if you look at, on average, a death claim would be between 500 and 600,000 full benefit. You know, a significant portion of that would be going to tax, and it actually affects the poorest of the poor in our view. And therefore, we've been lobbying with National Treasury and SARS and the FSB to indicate that if you look at also the way retirement funds are structured, most of your blue-collar workers would have approved life cover, whereas often your white-collar workers would have unapproved life cover, which doesn't come into the tax scale. And for that reason, it's become very important for us to lobby to make sure we can at least increase the net amount that gets paid for children by raising the tax level to a high level, probably closer to 600,000 than the current 315.
Do you find that after the vesting period, or at the age of 18, when the beneficiary fund has sort of done its duty, that the problems that it's tried to alleviate for so long then start coming in, because then there's a lump sum payout again, and then there's risk of mismanagement? Is there a transition period that is quite critical, or where, you know, all these benefits might unwind again after the period? I mean, there's nothing one can do about it, but is that something that does happen?
Yeah, Roland, I think you've hit the nail on the head on that one, in the sense that as much as we try to educate children for as long as we have the assets with them, it can fall apart at that point in time. Because currently no 18-year-old has passed matric yet. Normally the age-related for matric would be that they turn 18 in matric. And it is quite disastrous if you have to pay somebody in June or May of that year 100,000 Rand and hope that they're going to complete matric. So the change of the age of majority in 2007 has been very detrimental to what the objective of a beneficiary fund is, and completely contrary to that. So for that reason, we are also lobbying to make sure we can actually at least amend the Pension Funds Act to allow benefits to be managed until 21.
Just lastly, before we take a quick break, it's also important to look at investment strategy, specific investment strategy, depending on the child's age, then the members, of course, of the beneficiary fund. So just take us through that.
Yeah, I mean, let's quickly have a look at that. Again, let's look at the asset allocation here for just two different individuals. The one is a little pipsqueak, 3-year-old. This is basically how the asset allocation will happen. Basically 50% in income, 26% in money market, and then 24% in what is balanced fund, what's called a balanced fund. So equities, bonds, and cash, but with a swaying towards equities. And as you then mature and you become 15, remember the payout happens here at 18, you'll predominantly only have income-based based instruments. I mean, interesting that the asset allocation here is obviously not from a needs-based perspective. We're not looking at it from a needs-based perspective. We're just looking at it from a risk-based perspective. We're saying, how do we match this at 18 and then literally pay it off?